Hello everyone. Today I want to talk about something that has been making headlines and causing concerns among investors. The sudden dip in the Indian stock market over the last few months. From soaring highs to unexpected lows, the market has been highly volatile, leaving investors, analysts, and policymakers scrambling to understand the causes and its implications. Now, let's look at what led to this market dip and what are the few reasons. First is the economic uncertainty. Market sentiments has been rattled by the global economic concerns, particularly the US imposing reciprocal tariffs on trading partners, impacting investor confidence. Second is shift to gold amid trade war fears. Report indicates that US bank has been flying gold from London to New York amid fears of a potential tariff on European gold exports. This has triggered a shift in investors' position from equities to gold, contributing to continued selling in stocks. Third is disappointed Q3 FY25 earnings. The third quarter earnings session was underwhelming for the year FY25, with a single-digit PAT growth for Nifty and BSE 500 companies. This led to another round of downgrades, albeit less severe than before. The market has been particularly harsh on small and mid-cap stocks, with a 15.6% sell-off since January. Analysts expect a recovery from quarter first of FY26 as earnings stabilize and global pressures ease. Fourth is high valuation and market correction. Ahead of the new financial year, the Nifty is trading at a 1 year forward PE close to its 10-year average. Meanwhile, the savage correction in the mid and small cap stocks has brought the valuation below long term average, indicating a period of cautious trading. Fifth and last is the FII selling pressure. The foreign institutional investor or the FIIs have offloaded over 29,000 crore worth of Indian stocks as of mid-February 2025, while domestic institutional investors, that is DIIs, have stepped in with 26,000 crores of purchases. However, DIIs seem reluctant to engage in aggressive buying unlike the post-COVID recovery phase. Now, let's look at some of the sector which has been affected the most. Firstly, there are certain sectors that has been hit harder than the others. The technology sector, which had seen a massive rally during the pandemic, has witnessed significant corrections. Rising interest rate and reduced foreign investment in the IT sectors have led to sharp decline in valuation. Similarly, banking and financial services have also taken a hit due to concerns over the NPAs and slowing credit growth. Consumer goods and real estate, which are directly impacted by this rising inflation and interest rates, have also shown signs of weakness, and investors have become cautious about spending in these sectors, leading to further corrections. Now, let's look at some of the implications of the market decline. What does the market dip mean for the different stakeholders? Let's look at the implication of the market decline with the perspective of different investors. First is the retail investors. For small investors who entered the stock market during the COVID-19 rally, they have faced a very significant losses. The recent correction has been a wake-up call about the importance of diversification in long-term financing. The domestic institutional investors or the DIIs, while the FPIs have been selling, the DIIs, including the mutual funds and the insurance companies, have been trying to support the market. However, they alone cannot completely offset the foreign outflows. Now, let's look at the Indian economic point of view. A volatile stock market can impact the economic growth by reducing the corporate investment and affecting business sentiment. If the dip continues, the company may cut back on expansion plans, leading to slower job creation and economic activity. Last is from policymakers and RBI point of view. The government and RBI have been closely monitoring the situation. Measures such as capital market reform, policy incentive for domestic investors, and controlling inflation are being taken to stabilize the economy and confidence. Lastly, let's look at the future outlook for India. While the recent dip has been concerning, it is essential to remember that stock market moves on in cycle. The Indian economy remains one of the fastest growing in the world, and long-term prospects remain strong. Sectors like infrastructure, green energy, and manufacturing continues to show promise and could drive the next phase of growth. For investors, this is a moment to stay calm, avoid panic selling, and focus on strong, fundamentally sound companies. We have also seen the Indian stock market rebound in the last 2 weeks, supported by government policies, RBI's stable monetary stance, and robust sectoral performance in banking and manufacturing sectors, further boosting the confidence of the investors. The key to navigating the market volatility is to have diversified portfolio and a long-term perspective. In conclusion, while the recent dip in the Indian stock market has been unsettling, it is a part of a larger global trend. Challenges remain, but opportunities exist as well. As investors, economists, and policymakers, our focus should be on resilience, smart investing, and long term growth. Thank you.